Introducing a new era for discerning Australian investors. Brought to you by Ausbiz and backed by deep market insight, professional analysis and a proven track record. Our focus is simple: to connect you with exclusive and compelling investment opportunities. Discover what's next at ausbizcapital.com.au. This program is brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.
Hello and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Good to have you with us again here at Ausbiz. Let's get across what has happened overnight. Global share markets rallying, with an index of global shares hitting a record high as a fragile ceasefire between Israel and Iran took hold, boosting investor sentiment. Wall Street's main indices rising more than 1%, with the S&P finishing near its record high achieved in mid-February, the Nasdaq closing at a record. Financials, tech and healthcare stocks leading the way, while energy stocks were the largest drag as oil prices continue to tumble. Among the Mag7 stocks, Tesla underperformed, down around 2.5%. Broadcom touched a record high after HSBC raised the semiconductor manufacturer to buy from hold. Airline stocks gained amid easing Middle East tensions, but those defence stocks lost ground as we saw that Middle East trade unwind. Elsewhere, package deliverer FedEx fell more than 4% in extended trade after forecasting a worse than expected profit for the current quarter, and a sign that soft demand from consumers and businesses affected by tariffs is unlikely to improve in the near term. And shares of crypto companies rose after Bitcoin hit a one-week high. Well, a ceasefire is holding between Israel and Iran, while an assessment prepared by the US Defense Intelligence Agency indicates that US airstrikes did not destroy Iran's nuclear capability, but set it back by a few months. The Trump administration has said the intelligence report was flat out wrong. Meanwhile, President Trump has since flown to the Netherlands to attend the NATO summit, where he's maintained that member nations must spend 5% of GDP on defence. Now, in the US, Fed Chair Jerome Powell has told members of Congress that higher tariffs could begin raising inflation this summer. He said he would not open the door to a rate cut next month, despite fellow Fed members having called for one, saying if it turns out that inflation pressures do remain contained, then we will get to a place where we cut rates sooner rather than later. But I wouldn't want to point to a particular meeting. I don't think we need to be in any rush because the economy is still strong. Meanwhile, US consumer confidence unexpectedly deteriorated in June as households increasingly worry about job security. And the two-year Treasury yield has continued to ease, falling to 3.8%, the 10-year around 4.28%, and the US dollar falling further, while the euro has risen to its highest level in almost 4 years, and the Aussie trading at 64.9 US cents. Bitcoin, that is trading close to 106,000 US dollars. Now, oil prices have tumbled further below the level they were at before the Israel-Iran conflict began. Traders expecting the ceasefire will reduce the risk of oil supply disruptions in the Middle East. Brent crude futures falling 6% to $67 a barrel. Copper's up around 1%, iron ore down a similar margin to $92 a tonne, and gold has eased further on diminished risk in the Middle East. Spot gold trading around $3,320 an ounce. So let's get across all those market moves at the moment, particularly in light of what is playing out in the Middle East. Howard Silverblatt joining us from S&P Dow Jones Indices. Howard, welcome back. Good to catch up with you. Quite remarkable, these markets, aren't they? And their resilience, I guess, remaining in bullish mode, essentially, with more records on Wall Street. How are you seeing it?
It is amazing. The fact that we are literally 0.83% away from an all-time high. I mean, from what we've been through this year, I mean, from tariffs to taxes to oils to the Middle East to immigration. I mean, you could just name all these items that you think any one of them could have sank the market, but it has not. At this point, there's still optimism. The market is still looking well past the current events. Today's ceasefire, whether it holds or there's some bumps on it, we'll see. But the bottom line is that the money is still going in. The money that's there is holding. It is being helped by that Magnificent Seven, by the way. If you notice from that chart there, we're up about 22.6% from the April 8th lows a little over 2 months ago. And 43% of that is because of the Magnificent Seven. They were in for the last 2 years, and they were out for the beginning of this year, and now they are back in. Even though Apple is doing pretty poorly in them, the rest of them are doing well year to date. And from that April time period, we're there. Again, we are close to an all-time high at this point. And whether we make it or not, the economics are good. The earnings are good. Earnings season is about 3 weeks away, but the estimates have held up so far. The numbers are good. Powell today, as you said, spoke about potential cuts maybe in September. But he also said that he felt about a 3.5%, 3.75% rate would be neutral, implying potentially another percentage cut, whether it's under his administration or in 2026. He goes through May of next year, and then somebody else will take in. The expectations at this point is that they will be more dovish. But the market is bullish there. It is not even. It is not straight across. IT, communications, doing much better. We're seeing a lot of weakness in healthcare now, as well as some of the consumer stocks. So breadth is not that good, at least year to date. But the market is holding up on there, and we're not seeing anybody run to the sidelines yet.
Howard, Jerome Powell did speak about the effect of those tariffs, in particular on inflation. Now, of course, that July 9 deadline is looming. What are the expectations of what Trump is likely to do?
Well, that July deadline would bring another $146 billion into the U.S. coffers on an annual basis. And that tariff money, by the way, is being counted and used in the U.S. That's a major item. But what we expect at the July 9th, that you cannot put all these things together, is that most of them will be extended. A few probably won't if they're not negotiating coming in there, so you may get a partial on there, but not return to the top. But the majority of them, we are expecting another extension to go in there. And that will just push it out farther on there, more time to negotiate through there. We haven't seen most of the impact yet, but starting with the June numbers, which we reported in July, we're expecting to see the tariff impacts on the economy. But July 9th is not looked at as a real deadline. You just can't put it together that quick, even if everybody is in agreement. The paperwork and attorneys and the logistics of it take a lot longer.
And how Congress is also going to negotiate that big beautiful bill as well. Where is that at?
Well, the Senate is still negotiating with the House on there. They definitely have to change it on there. Key to that, and I don't mean to repeat myself here, is those tariffs. Those tariffs are what are going to be paid for the cuts. We not only have the cuts that are the extension, $3.9 trillion from Trump 1.0, but additional ones coming in there. So the House and the Senate are getting closer, but they're still not there yet. The big major items is the cuts in the medical expense, as well as certain credits. Major in there and important is how much of the debt they increase, because interest on the debt is very high now. It's about 18% of tax revenues, which is a very big warning sign. Think paying 18% of your interest each month without even hitting your principal. That cuts into your money. So the two of them have to come, and there's a deadline of around the 4th of July. You need that deadline in order for it to pass in the Senate. That way the Senate and the House could negotiate together, make a final bill, and pass it by the August recess. If you do not pass by the August recess, You have to wait till you come back in September, and that's a whole new ball game. Then you have to worry about reaching the debt limit because the U.S. won't have enough money to pay its bills, as well as the fiscal. The budget starts at the end of September. So they need to do it ahead of time. Major to the market is the permanent credits that are in both the House and the Senate. The House has it as only for several years, but the Senate is making it permanent. And that's for full deductions on capital expenditures, R&D, all different kinds of research and investment on there. That is a major stimulus to business and expected to push significantly into building and construction within the U.S. border.
Howard, do you see that markets are potentially looking through these risk events? And I guess perhaps we've seen that with how the Middle East crisis has played out.
We are looking past that, as well as the Middle East, as well as the tariffs and everything else. That's what we're writing, and that's what we're pricing on. However, when you go down to the bar, there's a lot of concern. There's a lot of things that can go wrong. Congress, just to begin with, the war in the Middle East, oil prices could jump up, inflation could start hitting in CPI and the PPI, and the Fed will have to react to that. The employment has held up so far, but there's definitely poor signs coming forward. Those weekly claims have been inching up. It's about 245,000 a week now. When we get to the 260, 270 range, 260 to 270,000 range, that's a warning sign there. So there are a lot of things that go, but the street is remaining optimistic on there. It's dangerous, and we are paying high multiples for it. But again, we are near a high right now. If you've stayed in, you've been rewarded in general. If you've been out, you still sat with a 4% return, in money markets, which isn't bad, but it's not the 22.6% we've had since that April 8th low.
Howard, thanks for joining us on S&P Dow Jones Indices.
Thank you.
Let's take a look at where we're likely to get going this morning. Marginally higher, it would seem. SPI futures up just 5 points. Now, just a reminder too, to join us, our next virtual investor event, the ABCs of derivatives. Do you know that derivatives can be used in your SMSF strategy? They can also be used for downside protection, extracting yield, and for leverage. So you can join our virtual investor event tomorrow to discover how to achieve upside after learning the ABCs of derivatives. That is Thursday, 1 p.m. Eastern. Registration is free, and if you are registered, you can watch live or on demand at ausbiz.co/derivatives. Stay with us. We're going to get across the open in just a couple of minutes' time.
This program was brought to you by LGT Crestone, local private wealth expertise backed by the stability of a global presence.